Hello, everyone, and welcome to today's Navigate webinar from the Northeast Clean Energy Council in collaboration with Mintz. Today, the webinar is dedicated to Special Purpose Acquisition Company, or SPAC, and our guests will be talking as well about the XL Fleet case study. This webinar has the invaluable support from Mintz. Mintz is a general practice full-service law firm known as a law firm that helped form and build the clean energy industry 15 years ago. Mintz advises NECEC since its inception and uses their industry knowledge to help businesses, from startups to Fortune 100 companies. Thank you very much for your support. Before passing the word to our moderator, I'd like to kindly remind you to use the Q&A feature to send your questions to the panelists, as to advise you that at the end of the session, you'll receive a short survey. Thank you very much in advance for completing it. And please note that nothing in this webinar is intended or should be deemed to constitute investment advice, investment banking services, or an offer of or solicitation to purchase securities by any CEC or any panelist. And now it is my pleasure to hand over the webinar to Tom Burton, Chair of Mintz Clean Energy and Clean Technology Practice. Thank you, Tom.
Thank you, Katerina. Appreciate that. And welcome, everyone. Good afternoon. Hope you are all having a good day. We've got a terrific panel set up here today. Cleantech goes public with SPACs. We're super fortunate to have some terrific experts on our panel in Deb, Todd, and Marc. Like myself, we have all been very active in the SPAC marketplace with sustainability-oriented businesses over the last year. There's really now an unprecedented opportunity and unprecedented activity in the clean energy space, where the public markets are being receptive to the clean tech oriented businesses. Is not something that we've really seen at any scale in the industry until now, and it pretends to help accelerate the growth in the space. As we get started, I'm going to just turn over to each of Deb, Todd, and Marc a minute to talk a little bit about their background and their involvement in the SPAC space. I think you'll find that we're really fortunate to have an incredibly deep level of expertise on today's panel. So Deb, I'll start off with you.
All right, thanks, Tom. And I'm excited to be on the panel today. I am currently a corporate board director for 4 clean energy companies: Renewable Energy Group, they're the leader in biofuels; ITC Holding Corp, they are a leader in electricity transmission; XL Fleet, which we'll be talking a lot about today. We de-SPAC'd the company back in December. And I also serve on Spring Valley Acquisition Corporation. And we recently announced our merger with AeroFarms. And before this, I spent nearly 30 years with General Electric. And my last role, I was leading the company's global clean energy innovation and sustainability strategy. So I'm delighted to be here.
Todd?
Well, it's great to be here. I'm Todd Hines, the founder and president of XL Fleet. I started the company in 2009 to focus on commercial vehicle electrification. We launched with a hybrid product because that's where the economics made sense. And as the cost of batteries came down, we introduced a plug-in product and are working on all EVs right now. We also launched our XL Grid division to manage the integration of our systems and plug-in vehicles into fleet facilities as well as other facilities. But I actually started my first clean energy company back in 2002 that worked in distributed power generation, working with a range of technologies, then went into wind development. So from 2002 to 2008, had a number of different efforts and experience in clean energy. Also started the MIT Clean Energy Prize, and teaching at MIT since 2008, a course called Energy Ventures. So have had a lot of different exposure to energy innovation over the years, and learned about SPACs about a year ago as the market started taking off, and saw a great opportunity to really scale. And as Tom said, it's a tremendous amount of capital coming into a lot of clean energy industry. So it's a great opportunity for the right companies out there.
And Marc?
Sure. Good afternoon, everybody. Marc Marano. I'm an investment banker with Canaccord Genuity. I've been with the firm for the last 16 years. and throughout that time have almost exclusively focused on sustainability related transactions. So we, as a middle market investment bank, we execute over that 16 years, literally probably 150 deals in sustainability, a mix of M&A advisory, late stage capital raising, IPOs, follow-on offerings, and SPACs. We were fortunate enough to advise Excel on its de-SPAC as the company's advisor. We've also worked on a number of other de-SPAC transactions. We've underwritten SPACs, and actually I am a CFO of Canaccord's own SPAC, which is a $207 million SPAC focused on finding a sustainability company.
Great, thanks, Marc. I'm going to start off just to level set, although I'm sure many in the audience have been reading nearly daily articles in the journal and other periodicals on the SPAC boom and trends. Let's make sure that we're all sort of on the same page in terms of what is a SPAC and then how that de-SPAC works. So, Marc, I'm going to just ask you to give us a quick tutorial on that topic.
Yeah, maybe I'll walk through the mechanics just to level set. So, a SPAC, typically, these are all typical situations. There's obviously some exceptions here, but on the mechanics, a sponsor group will form what is referred to as a blank check company. They'll take that entity public, with the sole intent of finding an operating business to merge into, and as a result of that merger, that operating company becomes a public company. So the SPACs, to do that, in their IPO, they raise amounts in trust. The amount in trust, which is committed capital. The capital is literally comes into an account, and that can range anywhere from $100 million to multi-billion dollars. I'd say the average is normally around $300 million in trust. The SPAC has a finite life. It can range anywhere from 12, 18 months to 2 years, and it is typically 24 months to go find that deal. And as you think about the SPAC, the SPAC investor, it's predominantly, at least in the IPO, large institutional investors, so mutual funds, hedge funds, and the like. They'll buy a unit, so that unit is in almost all circumstances usually $10 a unit, and for that we'll get a share and a warrant, and that's important because if the SPAC investor does not like the merger, they can ask for their money back. They can redeem and get that $10 back, but as long as they vote for the deal, they'll get to keep the warrant. And so the sponsors, the typical sponsors are people who would have natural deal flow, who would be able to identify companies that would work, that are good companies that would work well in the public markets, and the SPAC investors sort of have that real option, right? So that they can play on if they like it, and if not, they get their money back. But because you can get that money back and yet still be voted to be a public company, what is a critical part, and I think we'll talk about it during the course of the session, what a critical part is what's called the PIPE investor. So PIPE is private investment in public equity, and the PIPE investors are usually brought in after the SPAC and target company sign a letter of intent. Banks will take the company on a roadshow. They'll talk to the PIPE investors, who will then commit capital, and the PIPE investors can't redeem. So they commit the capital to do the deal at whatever the valuation is set at. That deal is then announced, and then over the next 2-3 months, you go through an SEC process before you go to shareholder vote for the SPAC. And because that PIPE investor is so critical, it's because you really want that capital, you want that validation, and they are the backstop in terms of having cash into the company once the deal closes. You can't overestimate the sort of the importance of those PIPE investors in the process, and we can get into the current PIPE market as we go through the session.
Thanks, Marc. So I'm going to gear the next question to you, Todd, which is going to be, why undertake a SPAC transaction? But let me just do a quick summary, which is, so right now what we've got is we've got a publicly traded shell entity, which is holding a bucket of capital, bucket of money. And that money may or may not wind up into may wind up in a combination with an operating business, which would create access to capital, but it's redeemable, so it may or may not. And then there's this third piece, which is the pipe money, which is another bucket of dollars, which might accrue to the benefit of the operating company. So if you're an operating company and you see this opportunity, you see a shell holding on to some money, and you may need to raise additional. Why undertake the transaction? It seems somewhat more complex than maybe a traditional IPO, Todd. So tell us what was going through your mind as you were thinking about that process of partnering with a SPAC.
Yeah, so there are a few different things. One of the first things you have to think about is, are you going after a very, very big opportunity? Is the market, the total addressable market you're going after, big enough that you are going to need, and that you need a significant amount of capital, not only the cash that you get in the transaction, but also the value of your stock, which you can also use for acquisitions, to go aggressively after that opportunity. So you need to be going after a really big opportunity. You need to have a need. You have that need for capital. And as far as why not go through a traditional IPO route, the pace at which you can close on a SPAC transaction and the certainty that you have with that is significantly higher. And I think we're a very good example. If we had gone down the traditional IPO route, we would be doing the IPO right now. And there's significantly different market conditions than there were in the fall of last year when we closed, fall, beginning of the winter, when we closed our transaction. So the market, these equity windows open and close. The market dynamics change very rapidly, and we had a much more certain path going down with a SPAC transaction. We were considering other options as well, a large private raise. I know entrepreneurs that have gone in that direction as well. So you need to have a couple things in your favor. You need to have good public comps that you can point to. So there's companies that are already public or have already announced a SPAC that you can really show, we're doing the same thing or we're doing it a different way, but these are the companies we're comparable to. And if you have those things, then I think you're in a good spot to go down the SPAC path.
Yeah, and it seems primarily, the key thing that really helped you guys was, access to capital. That it really is an alternative IPO. While there's a merger or M&A transaction involved, it is about access to capital, and that's an important consideration.
Correct, and it's also important to know you don't know how much capital you're going to get at the close. So you're sure to get the pipe at the close of the transaction, but you don't know how the market's going to react to the announcement of the deal, or how that changes over the course of the few months it takes to close the transaction. So you have to have a plan that aligns with the pipe capital, and then you have the ability of effectively deploying a lot more capital if you are able to close on that. So when we went into our process, we were looking at a minimum of 150 million. We ended up closing and getting pretty much all the capital, so netting close to 350, and then even redeeming the warrants to get over 400 million total of cash through the transaction. So very effective process. We established a leadership position in fleet electrification with about 70 million of capital over a 10-year time frame. We're now in an extremely good position to scale, especially given how fast this market is now moving with all the capital that we have, plus our customers, our supply chain, our technology. So it really put us in a great position in an industry that is really taking off. And we're actually on the ground already putting a lot of units on the road, which is a great place to be.
Great. Now, Deb, as a board member, you're in a great spot, because you're not only a board member of a SPAC seeking to find a partner, a company that will go public, but also on boards that have been involved in the de-SPAC process. And so one of the questions is a good board member must know the pros and cons of all of these types of transactions. And so how did you, as a board member, think about analyzing the benefits of a SPAC? Some of which we've covered. There are others as well, but also some of the risks or downside potentials for them as well.
Yeah, no, it's a great question. And, really, as you're considering a SPAC, you really need to look at both sides. Todd just shared with you, the board, we were looking at a potential E round, for Excel. And it was going to be one of our larger capital raises. And, we hired Marc and the team to help us think through and come up with what the alternative potential capital funding mechanisms were. And so the board had an assessment. We put a subcommittee together to review everything as well, very thoughtful about what were the appropriate steps for the company. And the pro side of this, Todd stated it very, very well. We now had access to capital at a whole new level that we could really take that investment into the company and really scale the company in a great way. And we were, we had revenue for the last 5 years. We had lots of customers. Technology was proven. So it really was, timing was right. And, we were managing cash flow like many companies are, and we could close the SPAC in time. And, the process is, it took about 5 or 6 months. And so that was another requirement, as we assessed from the board perspective, when we could close the transaction. On the con side of things, or the things to really reflect on beforehand, is you got to be ready to be a public company. Are you ready? Is your management team, ready? Have they had public company experience? Are your financial infrastructure ready and compliant, operational excellence, just making sure the readiness of the company is there, because it is very, very different being a public company versus a private company. SEC requirements, compliance requirements, and you got to deliver on your numbers, right? You are now delivering to shareholders. And when that doesn't happen, there is tremendous scrutiny, and you really have to navigate that. So making sure management and the board are assessing both the positives and, some of the challenges or the opportunities. You really want to have those tough conversations and make sure you are ready for it.
Great. And Marc, from your perspective, some pros and cons, maybe, sitting as an underwriter on these, as well as on the board.
Yeah, actually, maybe I'll talk about it maybe in terms of SPAC versus traditional IPO. And one of the reasons I like the SPAC is that you get to the answer quicker, right? So in a traditional IPO, it takes a month or months to write an S1. You go through the SEC process. That takes months, and you could be 3, 4, 5 months before you're going to the market, and the market could be closed. Todd mentioned it. If you went today versus 3 months ago, right? The market can be closed. These windows open and close quickly, and also you've spent millions of dollars, right? With lawyers and accountants and bankers and the like. So it's time consuming, and it's time consuming and expensive. The reason I like the SPAC is that you get to go to the pipe investors who basically are the who's who of institutional investors, and you can do that within from speaking your first discussion with a SPAC to LOI to pipe discussion can be less than 2 months, and so you can be talking, and those pipe investors will tell you, yes, we want to invest or we won't. And so you're basically pulling in that answer by months. Now, you may not become, in my mind, you get to the end line, you're a public company, not in a too dissimilar time frame, because once you announce the deal, you have to do a lot of that SEC work and you have to do a lot of the filing work. But you have your deal done, you have your valuation set, and you have your money committed. And so that is a huge benefit. I think the big cost of all that, economically anyway, is that you'll have a little bit of extra dilution to do that, because you're basically, you need to compensate, my word, but sort of compensate the sponsors for their time and effort. And that comes in the form of sponsor shares. But when you add up all the fees, it's an expense. It is, it's incrementally bigger, but what we have seen and experienced is that the amount of capital at stake, the valuations that we're talking about, and the time to market is worth the incremental dilution.
Yeah, and I'd add a couple of others. There is the opportunity for liquidity, right? So following the expiration of lockup periods, which are traditional, like a normal IPO at 6 months, shareholders of the operating company, which once was private, is now public, and there may be opportunity to sell into the market. And then on the I guess on the con side, as was noted earlier, there is the risk that the shareholders of the SPAC don't like the deal and they decide to redeem their stock, hold on to their warrant so they can keep a little upside if they're wrong, but they get their money back. And so the PIPE then results in being the only amount of money raised. And so costs relative to the raise could be quite extensive. So it's not without risk like any financial transaction. So worth just noting that point as well. So we've because we've covered pros, benefits, and so forth, I'm going to put a little bit of a spin on it, but I guess the question would be, when we think about how to make a successful de-SPAC transaction, one in which the operating company raises the capital, like Todd mentioned, one in which the sponsors do well on the SPAC, and one in which the PIPE investors, stay in, and there are minimal or no redemptions in the trust. What are the ingredients, the special ingredients to making a successful de-SPAC transaction? And I'll open that up to all three of you. Maybe Todd, if you want to start.
And I mentioned it earlier, but I'd say comps and momentum. I mean, if you have good public comps and the segment that you're in has positive momentum in public markets, that is going to make the process a lot easier. Obviously, you want to have your stock above the $10 floor, initial price. So you want the markets to react well to what you're doing and continue to react well as you're going through the whole process, because there are different stages. Obviously, when you announce the transaction, when you close the transaction, and then many of the SPACs have additional warrants that have, typically redemption rights if you achieve certain targets. So as long as you have, again, good public comps, good momentum, and then continue to execute. So having a number of, deals, things that show you're, achieving traction and continuing that momentum is, I'd say, the key thing.
Yeah, I agree. And just building on that, I mentioned this before, right? It's the readiness of the company and management and, being able to deliver and navigate and, deliver to the street, your shareholders, your stakeholders, and being able to execute. And so I think, that readiness and having the right management team and resources to really fulfill, I think is very, very important to being most successful in a de-SPAC.
Maybe Tom, I'd add I guess in my mind, the hotness of the SPAC market is probably 10 months old, right? SPACs have been around for literally decades, but the significant focus on it in my mind is a little bit less than a year. I would say in the first 7 months, right? I think for the last month it has changed a bit, but for a bulk of the time, the institutional investors were looking for big markets, big explosive growth opportunities in those markets, companies that had sort of long-term competitive advantage in those markets, good team, really good growth prospects, good margins, like not too dissimilar to what everyone looks for, right? In a certain sense. I'd say over the last month, it's evolving. I'd say a lot happened quickly, and I think you're going to start seeing, again, not every single deal, but I think the rule is going to be a little bit more later stage, a little bit bigger, a little bit more de-risked than what was happening in the first in the first 7 months. It's just a natural evolution as to how these things occur. But that's still being written as we speak, because it's such a dynamic market.
Yeah, and one other item I think I would say for me when I see these deals work well, the pipe plays a big role. Essentially, as you think about it, the valuation that will be ascribed to the operating company by the SPAC is, particularly if it's an earlier stage business, it's a bit difficult to determine, especially as well, given that it's based off of forecasts, which I think is another advantage over the traditional IPO.
Yeah.
You can use forecasts that you can't use in a normal IPO. And the PIPE investors serve as market validators. By agreeing to invest in the company, they validate the valuation that was placed by the SPAC on the operating company. So it's critically important. Marc, I don't know if you want to add more to the.
I do actually, real fast.
Yeah.
I think again, those first 7 months, it was there was a lot of valuations being driven off of out year financial projections. Everything was, not everything, but most were being benchmarked off of 2024, 2025 revenue or EBITDA. I'd say over the last 3 or 4 weeks, that's still a big part of it. I would say, though, there's been a very new focus on what was the last round done at, right? I think there's a lot of where that was not really focused on in the early days. I think, hey, you raised cash, 12 months ago, 18 months ago, and we think your valuation should be that's a sort of a benchmark we want to use to do the analysis that the PIPE investors are saying that we want to use in order to set this new valuation. Whereas before that was a bit ignored. And so I think that is a newer phenomenon, I guess, again, over the last several weeks. And I think there's again just an increasing level of I don't say cynicism, but reservedness within the PIPE investors, right? That they're maybe factoring in some of the venture-like risk on some of these earlier stage companies.
Got it. Yes, we're coming into some of where we think the markets are headed. Before that, we get to there, and we've got some great questions coming up too. So really appreciate the Q&A coming in. We're going to spend a good chunk of our time on Q&A. But before we get to that, this is about Cleantech and sustainability, and we've been talking about this, feature in this financial instrument or structure, I should say, more generically. So I think folks are probably interested in knowing, well, how much of this are we seeing in the clean tech space? Is it really as robust a trend as we're hearing? And the answer is yes. And Marc, you might have some statistics on that.
Yeah. Maybe I'll step back and give broader context. I would say sort of quick research. Since over the last 4 years, right, I think there have been roughly around 700 SPACs that have IPO'd. Approximately 250 of those were last year, and believe it or not, almost 300 this year, right? So even though we're only in the first 3.5 months, we've already the SPAC IPOs have already eclipsed what had happened last year, which has dwarfed what had happened in the years before. Sustainability is definitely an important theme. The amount of cash flowing into the institutional investors where the investors and the investors, the limited partners or the endowments, the pensions, that money is putting a lot of pressure to find ESG themed businesses to invest in, which is one of the great things where, again, we've been in, Tom, I know you have as well. We all have been in this market for over a decade. The pressure on finding these themes and taking advantage of the long-term secular trends is nothing like we've seen before over the last 15 years, which is great for climate. And as a result, you are seeing a lot of sustainability themed SPACs. I want to say there's been dozens of ones that have already closed on their deal. There's another, I think by last count, maybe 42 SPACs that are specifically targeting sustainability deals sort of on the hunt, and then ones that are more generalists who are also looking for those themed businesses. And then there's another 34 sustainability themed SPACs who have announced their deal with the publicly announced who they're merging with, but have not yet closed. So it's definitely it's target rich for the for the SPACs, because that's you're talking 40 plus who are still looking, plus the hundreds that are generalists who would also love to find a good sustainability themed business.
Yeah, that's great. And we're seeing the same thing. It seems to be not letting up. I mean, even in this last few weeks, we've seen a number of SPACs, SPAC IPOs in the space, and multiple SPAC IPOs. So ArcLight had a Clean Transition Fund 1 last fall. They quickly found a SPAC partner. They've now gone to IPO for their second fund. So we're seeing multiple funds being raised by private equity, looking for exposure to the clean tech sector, which is, I think, terrific. I'm going to dive into Q&A. I want to cover off two things, sort of trends and Q&A. So I'll sort of do this sort of simultaneously, I think, for all of us, if that makes some sense. Some of the questions here are pretty quick answers. And if they're quick, I'll give them a quick answer and move on. Others are going to require a little bit more panel intervention, I'd say. So, the first question that I see, I'm just going to take these in order as I've seen them today, is, what typically is the strike price of the warrant given the standard initial price of $10 a unit? Typical strike price of the warrant is $11.50. The second question we see is actually from Brian Allman from Los Angeles. So thanks for coming in to this Northeast oriented call or panel here, but obviously the subject matter applies nationwide. So the great question: what happens if after 2 years you don't find a partner to merge with and close with the allotted time period? Does this ever happen? I think I know the answer, but I'm going to ask Marc and Deb because they're both involved in SPACs. So what happens after 2 years, guys?
You give the money back. So you give the money back. The investors get their $10 back, and then the sponsors who spend millions, by the way, the sponsors who spend basically lose that money, assuming it's all been spent, getting public, hiring the lawyers, the accountants, and doing the search for those deals.
Yeah. And just to add on to that, and correct me if I'm wrong, but, some SPACs are 18 months, some of them are 24 months, right? And so there is, definitely a short window, to seek your company. And so, you are somewhat time constrained for sure.
Yeah. Exactly. So one of our folks, Andrew Brider-Wu, asked if we were in a SPAC bubble. I'm going to save that one for later because that's that everyone's going to have some opinions on that one. But in a more focused way, a couple of other questions. An anonymous attendee asked, do founders and employees of the operating company that will merge with receive cash from the exit transaction, the SPAC merger with the SPAC? And if so, how do they, calculate, those cash out amounts? Maybe Todd, you can give your experience and hear what the others have to say.
They definitely align the SPAC transaction for success. I mean, when we were negotiating our term sheet, we did have a 12-month lockup period. So the shareholders, founders, employees, everyone was aligned in terms of that long-term alignment with the business. So there are certain investors who can sell at any time. Obviously, somebody that's bought the SPAC in the public markets can buy and sell whenever they like. The PIPE investors have a bit of a delay as to when they can actually sell. It's typically 60 days in that range. But the founders are in it for a while, so you got to execute. There's no technically, I think you can get some money out at close, but a lot of times the SPAC team will make sure that there's alignment and people aren't taking money off the table. I apologize for the background noise.
Yeah, I can add that as well. Most, we call it secondary component. Most SPACs do not have a secondary component in the in the deal, other than being able to sell once the lockup is done. I think there are always exceptions to rules. I think the most likely scenario where the it's not just the SPAC investor, it's really how the SPAC itself views what the public markets will view as secondary component, as well as view the pipe investors' view of the secondary market. I think if it's a more mature business, hundreds of millions of revenue, hundreds of millions of EBITDA, the risk profile changes a bit, and there's a little bit more latitude to have some secondary shares as part of the deal.
Yeah, and I don't know if Deb, you have a follow up on that, or I can just.
No, I mean, I think Tom just, is, the audience has different levels of education and understanding of SPAC. I mean, the lockup period is for 12 months, but there are, different criteria, and Marc can probably speak to this as well. I mean, if you hit a certain threshold of stock price for, so many days within a 30-day period, that lockup period goes away, and people can, definitely, sell some of their stock. So there are, various mechanisms in this, but I think it is good to have, management, what the original question was, management, board members, employees, locked up in this process. So you do have some execution and delivery back. So.
Yeah, and I think as the market is changing and valuations may be going down in some cases, and unless you have a company like the one Marc sort of described as a high revenue, maybe profits as well, the ability to take money off the table up front is going to be less likely. I'm going to move on to the next question, which is what is the sponsor shares or the promote? What is that percentage ownership? And I think that, a person said, I've heard this as being 20%, but of course the question is 20% of what? How does this work? So, and then a related question is, can the sponsor shares be allocated based on the amount of SPAC investor redemption level? So maybe Marc and Deb, you can talk a little bit about sponsor shares and ownership relative to the SPAC.
Yeah, so 20% is market, and it's 20% of the amount raised. So the way I view it, on a $200 million SPAC, right, $10 a share, that's 20 million shares, and think of it as 4 million shares of sponsors, right? So the 20% of the, actually a little bit more. It would be grossed up for so 20% of the number of shares owned post sponsors. So I needed to show the math on it, but it's of the amount raised in the SPAC.
Yeah, and so
I just say it's important to clarify that when you close the transaction, right? So we close the transaction, that gets diluted down to 4% in our case. So it was the billion dollar valuation plus the money raised in the SPAC. So that 20% is of the 20%.
Yeah.
So from our perspective, it wasn't that big of a number. So it was like 4%.
Thank you for adding that. That's critical, right? Because on $1 billion, if it's $1 billion enterprise value, right, that means the owners of the operating business are getting 100 million shares, right? And the IPO SPAC investors have 20 million shares, right? So they have 120 million, and the sponsors would then have, say 4 or 5 million shares. So so from the broader scheme of it, it's a much lower percentage than that 20% would at a headline level would suggest.
Yeah, that's exactly right. And one thing that's important to also remember is the valuations. I lost my train of thought. Sorry about that. But I'll get back to it later. But the numbers, the SPAC itself can only purchase businesses that are of a certain minimum value, and more often than not, what you're seeing is that the vast majority of ownership when you're done with the public company is with the shareholders of the operating business, and so that's an important distinction. Yeah, go ahead, Marc.
And Tom, just on the other question to ask, I think they asked what was asked was whether or not they tie the sponsor shares to the redemptions, and that's sort of negotiated with the operating business within the deal. So obviously sponsors hate it. There's a lot of and a lot of them won't entertain that at all. but others will, depending on the nature of the deal. But I wouldn't say it's normal. I'd just say it's possible.
Yep. Okay, great. And then next question is actually a really good one. So the question is it common that the PIPE share price be above the initial price for the SPAC transaction? And if so, what level of premium have you seen? So the SPAC, when it goes public, is priced at $10 a share. The PIPE is typically also priced at $10 a share. And have any of you seen anything higher than that? I have not typically seen that.
Yeah, I think I've seen one. I can't remember the name of it. I've seen at least one, maybe more. It's we could get into financial theory. Personally, I don't see a huge benefit to it, because you either increase the price of the PIPE investor share, which has basically the same impact if you adjusted the enterprise value of the company we're merging with. And so anyway, so I don't want to get into that. It's sort of complicated math, but from my I have seen it. I don't think it's common. We'll be interested to see if you see more of it, but
great.
But you're absolutely right. It's usually $10.
Next question relates to the lockups. I think we've kind of covered it in Deb's comments earlier, but the question was, are existing stockholders subject to lockups? The answer is yes. As a general rule, most certainly significant shareholders, officers, and directors. And then in some cases, our SPAC lockup period is longer than a traditional IPO. And as Deb and Todd noted, that yes, they can be longer, particularly relative to the idea of alignment.
Mm-hmm.
Okay, so then moving on, Tom Sun asked a question: do SPACs have a lower requirement than IPO? What might be some reasons companies choose IPO over SPAC? Not sure if I know what lower requirement means, but maybe we could all throw our own gloss on that and take some comments from the panel.
Yeah. So maybe I don't mean to. I guess I'll start. I would say the SPAC phenomenon over the last 10 months, in my mind, you have seen earlier stage companies go public than you would otherwise have seen in traditional IPOs. So I think from that perspective, lower requirement. I'm not sure if that's exactly what was being referred to, but you have seen earlier stage businesses. I do think there are one of the reasons for that. I would argue is that investment bank in terms of a traditional IPO, the investment bank tends to be the gatekeeper, and so an investment bank may be a little bit more hesitant pre the SPAC phenomenon to take a more speculative business public, because the amount of time and resources that a bank needs to commit to taking that company public are significant. It's hundreds of hours, it's millions of dollars, and you don't know if the market's going to accept it or not. And so I do think one of the reasons, again, I like the SPAC is that the bank no longer becomes the gatekeeper as to making the decision, like a risk return decision on resources. At a sort of a lower cost and a lower time, you can get to that answer. And so and again, I haven't seen a lot discussed about this, but this is sort of my own personal opinion. I do think you're seeing earlier stage companies go public because of that, which, by the way, I think is good, because I think more diverse capital coming into these companies is better to fund sustainability companies. It's better on a cheaper capital and the like. Again, I'm not sure that's exactly what he was asking or he or she was asking, but based on my understanding what was asked, I guess that would be my response to that.
Deb or Todd, any additional color from your perspective?
Deb, you can go ahead, or I was just going to make a quick comment around the S4. I mean, we still have to file some pretty extensive documentation, and S4 is basically, I'll defer to you, Tom, or Marc, to go into the difference between S4 and S1, but I mean, it's a 400 page document that's very extensive. So you do go through a lot of this similar process. I'd agree with Marc in that, this is a huge opportunity for especially climate-focused companies that are potentially in industries that are emerging, and it's all about future growth. It's all about this is the direction that the world is going, and there aren't as many historical quarters to look at. So there is an opportunity here where if it's going in the right direction, and if that's the future, that's what the market values. That's been clear to me. It's all about the future, so that's something to keep in mind. I'd say IPOs can still achieve that, but as Marc said, there's some restrictions or tighter gates in terms of getting the banks to sign up first, which is obviously not the case with SPAC.
Yeah, and just Marc and Todd did a great job. I think, Marc is absolutely right. We're taking companies public that, are a bit more early stage. And, the process is, it's a pretty robust process. Like we said, 5 or 6 months, that you're coming to market. And I do think, Tom, there will be more scrutiny about some of these companies. There's just been a lot coming at, and, there'll probably be more scrutiny from the SEC and others around this. We'll have to wait and see.
Yeah, on that point, I guess I'll chime in a little bit on SEC. What we are seeing is that the Division of Enforcement, Accounting have all had some recent pronouncements. The SEC is reminding companies that are in the de-SPAC process or have de-SPACed of their obligations relative to disclosures under the law. The SEC has also sent out letters to all of the major investment banks asking them about their processes, which is really how are they diligencing the companies that are being acquired in the SPAC process. They have noted that there are potential conflicts of interest in the way these transactions are structured. How are they dealt with? So that heightened scrutiny is going to continue. Whether that will result in additional rulemaking is a little bit uncertain. Historically, the SEC is quite slow to move, and so what we've seen is a couple of dynamics have to happen. There has to be a massive failure, a fraud, or a really terrible outcome that hurts the common investor, the Robin Hood type, I suppose, and then from there, rulemaking usually is passed over what it takes committees, proposals, feedback from the marketplace, before rules are final. So you're looking at 1 year to 2 years. And so in our prior experiences with reform with the SEC, reforms really only come into play long after they're actually needed. The markets tend to move away, really. So we'll see what happens. They may move a little bit more quickly here. I would say a trend we are seeing is just greater attention to diligence. So Deb and Marc are looking at their potential acquisition candidates, are probably instructing their lawyers and business colleagues to turn over every single rock to really confirm the solid state of the business.
Mm-hmm. Yeah, no, that's absolutely right. The due diligence on the companies is very robust, and I think is being asked to be even more robust because of what's happening. Looking at fees and due diligence and everything, just having a really rigorous process as you're looking at who you're going to de-SPAC.
Yeah, and I think a trend we'll see, and I know, Marc, you have this with your SPAC, is to require a fairness opinion from an independent third party, another investment bank, an independent third party, passing essentially on the valuation, or the process anyway, the valuation undertaken by the SPAC in valuing the operating company that it's merging with. Yeah. I'm going to move on to a couple more questions. We have a good, robust set of them, which is great. We can probably get through them relatively quickly. One person, Scott Lancelotti, has asked, who manages the company going forward? Is it existing management team or acquiring SPAC? So I'll put that to Deb and Todd.
So from an Excel perspective, the existing management team, Todd as founder and Dmitry Kazarinov as CEO, have remained, but your governance board is obviously your management team, independent directors that are comprised of independent people like myself, industry people, audit chair expertise, as well as, in many cases, the sponsors of the SPAC have 2 or 3 seats on the board as well. So you've got, anywhere from 7 to 9 board members comprised of both sides of the team. And, I think that's appropriate. And Todd, I don't know if you want to add more.
I mean, we've kept our existing management. We brought on additional management just because of the additional resources, but the SPAC sponsors typically keep a couple board seats, 2 or 3. So in our case, we have 3 from the SPAC and then 6 additional board members, some from our previous board, some new members, and management as well. So, but the existing management, continues to run the business.
We're going to direct the next question to Marc, which is one of our attendees has asked, can you define what are PIPE investors? So maybe we could just spend another minute on, who they are, just to help clarify for folks.
Yeah. So again, I'm going to talk generally. It's generally the big institutional investors, right? And actually, a lot of the companies, when they announce their deals, will list who some of their key investors are. But it's the Fidelities and the Wellingtons and the T. Rowe Prices. I mean, it's sort of the names So it's the traditional big mutual fund complexes is a big piece of it, and then it's the well-heeled hedge funds, right? These are multi-billion-dollar hedge funds who are backed by their own institutions. So it's big institutions, which is because the check sizes, right, you're trying to get are tens of millions of dollars, and they need to be set up. And you also want that validation with the PIPE to come from the big institutions. You are seeing some, you will see sometimes existing shareholders will then also double down into the PIPE, or other strategics will put money into the PIPE. But the core of it are the big money institutions.
Great. So I'm going to keep scrolling down. We're down to our last 5 minutes. I want to get to the question of the bubble as well. So we have a question about diligence, which I think we've covered. We have a question about where do the board members come from? They come from all walks, I guess. But I would say that at least in sustainability, the savvy operating companies are looking for board members that have relevant experience in the industry who could be value add. So SPACs, I think, to be successful, ought to be formed with boards that have strong industry relevant folks with good execution experience. One person asked, how do I approach a SPAC for my company? Do I need to we need to hire a financial advisor company for that? I think you do need to hire a financial advisor if you want to de-SPAC. There's just to try to hire an expert who can help you get through the market. Trying to run through these, can a SPAC acquire multiple companies with one SPAC? I don't see that. I guess it is technically possible, but usually it's one acquisition, and then it could be the linchpin behind a roll up, I suppose, right? But that's tend to be what we see. Term time to strike on the warrant. So though maybe the warrant redemption comment, this relates to that. So perhaps Todd, you could give us 2 seconds on your warrant redemption situation. Sounds like you raised money with the warrant exercise.
In our situation, if our stock price was above $18.50 for more than 20 or 30 days, we then had the option to redeem the warrants and bring in some additional capital to the company. So that occurred through the December through Feb timeframe, and we were able to bring in that additional capital.
Okay, great. So I'm going to roll this all into the last 3 minutes of comments. This relates to I think one of the challenges, someone asked a question about, what about the post-SPAC market? Once you're a public company, you're subject to all of the risks around securities lawsuits, class actions, particularly in growth markets where you have high volatility. That's a reality. Maybe we can address that as a trend point. And then, folks are wondering whether, what you'll see in terms of changes in pipes and SPAC value, given the pipe market is cooling off. So I guess final comments from each of you on sort of trends, bubble, and, what are the implications of being the public company? Deb, maybe you could start.
Sure. So, I think, Tom, just from, some of the trends that we're seeing, right? There's scrutiny in the market, like Marc said, a lot of 7 months ago, right? A lot of companies might not have had revenue till 2025. And so there's just a lot of scrutiny that happens in the market. And, that can drive short sellers or some type of activism or, anything like that, that you're going to have to navigate, potentially through. I think, the market has changed a lot. I'm on both sides of this, right? The de-SPAC with Excel last fall, it was just a boom market, really, really robust market. And now on the Spring Valley side of things, being in the market now, we're seeing a different market. And, you're going to have to potentially reprice deals, or the pipe might not be the dollar amount you expected. It might be smaller. There's just more scrutiny. There's just so much that has come into the market. The investors just need, a breath. And, I'm still an optimist about, the market, but, you will have some ebbs and flows for sure. There is definitely oversupply right now. And, we mentioned some of the stats just around how many SPACs and IPOs, and even on top of all of that, there's some secondary offerings, from some of these initial SPAC, de-SPAC companies. So I'm still optimistic, and you just need to navigate the market, quite honestly, and do your due diligence appropriately, and have good partners. Mintz and Canaccord were excellent partners for us on the Excel side.
Todd, then maybe Marc.
So I think the SPAC structure, as is going to stay. It's a tremendous way of bringing capital into the market. It's essentially a free option for the IPO investors. They get to, sell or get their money back at the amount they put in. So as long as there's a free option, people are going to take it, especially when there's low interest rates. And what we've seen is there's a bit of a choke point in terms of the amount of pipe capital. And then deal flow is obviously going to be a big driver. Are there enough companies out there? And I think there will be. It's going to take a little bit of time. There also are divisions of existing companies that could be spun off. We've seen some transactions like that. I think you'll see some more. So there's definitely ways of putting the capital to work, especially given the challenge that we're facing with climate change. It's going to take a lot more than a few $100 billion to solve that problem. And so. There's plenty of problems in the world that need to get solved. There's a lot of good companies that are out there trying to solve those problems. So I think that the structure will be there. I agree there'll be some changes, but overall, it's going to be I think a good thing for markets and for the world.
I know we're running out of time. I'll just say, to be upfront, that the pipe market is very challenged right now. It's just there's a lot of deals. The pipe market, the pipe investors are sort of reanalyzing what they've, what their book looks like, what it should look like, and as a result, I wouldn't say it's stalled, but it's significantly slowed down. I think unfortunately time will tell as to how that loosens back up. But that can be a whole other panel, to be frank. So, right.
Thanks. Well, thanks everyone. I think we're down to maybe some airs being let out of the balloon to the extent that there is a bubble, and hopefully it'll be rationalized. Right. I want to thank our panelists for taking the time today. We really appreciate all of your expertise and the willingness to share it with the larger community here. And want to thank everyone for attending, taking time out of their day. I hope that you all learned a little bit, and please don't hesitate to reach out to the council or Mintz or any of us if you have questions or need any further guidance. We look forward to many more successful financings for the clean energy sector, because as Todd said, God knows we need it. So anyway, have a good one and enjoy the rest of your day, everyone.